One of them is default risk. It is entirely unthinkable for a authority, sovereign government that has authority to print its own currency to default on bonds that are denominated in that currency. You know, as you know, Russia is in collapse, right? For a lot of different reasons, but one of them is the war and the sanctions thereof. Can you imagine that Russia would ever default, independent of how the war goes, on bonds denominated in rubles? No. Why? If they need to, they can print the damn thing and pay with that. Same thing, US. Technically speaking, it's the Federal Reserve that can print the paper currency, but US Treasury has authority to mint coins. I can mint a coin from gold that's as big as that computer and call that $1 trillion. That is legal currency. Deposit that into Fed, pay $1 trillion of that down. Done. Sure, that would create a lot of inflation, but there is no default. But local authorities are not like that. Kentucky cannot print money. The only way Kentucky can pay anything if they have revenues. Technically speaking, budget wise, Kentucky state budgets have to be balanced because that money has to come from somewhere. You know, you can work around that with government accounting tricks, but over long periods of time, it has to be balanced. So if something happens, for example, when Matt Bevin became governor, I think it was in 2015, if I'm not mistaken, within 2 years, something really went bad. They completely screwed up the pension funds and stuff. Because of that, EKU lost almost 10, 15% of its faculty because the funding went down. They had to even fire some tenured professors, which is almost unheard of in academics. If you're not tenured, you know, you're one of the first ones to go. But if you're tenured, that's considered exigent circumstances. We even have a policy how to do that. I used to be a member of that committee. It is possible that state of Kentucky may not be able to pay back. That is called a default. In mid 70s, the city of New York defaulted on their bonds. That happens, which means everything else being the same, if after-tax returns of U.S. Treasuries and Kentucky state bonds are exactly the same, I would prefer U.S. Treasuries. Why? Those yields are promised yields. If I have a coupon of 4%, I promise to pay you $40 every year. But sometimes you want to keep your promises, but they can't. You tell your girlfriend that you're going to be there at 4. There's the pileup on I-75. You can't. So default risk is that kind of risk. So on average, even on an after-tax basis, municipal bond yields are higher. Why? There is something called default risk premium. This kind of segues me into the next section, which says what differentiates the returns of different types of bonds. Another one is liquidity risk. Of course, there's a premium associated with that. This is a premium that issuers have to pay if expected size of the secondary market is small. Let's say I'm a pension fund, I have $1 billion of 30-year US Treasury bonds. It would probably take you about 15 seconds to sell that without actually affecting the market price because it's very deep. If I had $100 million of Kentucky state bonds, by the time I'm able to sell it, I'm going to have to take a big haircut. Why? The issue sizes are typically smaller. U.S. government has, in terms of bonds only, bonds that are trading, probably around $10 trillion. The state of Kentucky, the biggest issue ever would be maybe half a billion, the total. Okay, so selling 100 million, if you want to sell it quickly, you're going to have to take a big haircut. That means everything else being same, if I have those bonds and I want to sell them for something, I'm going to have to take a haircut. So I'm going to ask the state of Kentucky over and above and a default risk to compensate me for that. That's the default risk liquidity risk premium. This even happens. There are liquidity premiums even among U.S. Treasuries. The way 30-year bonds are issued every 6 months, U.S. Treasury does an auction. Basically, it tells people, I'm going to sell this much worth of 30-year bonds. You guys bid on that. It's kind of a modified Dutch auction. And sometimes you can say, I'll just buy out of average. Sometimes you say, I won't buy it unless the yield is this much. Something happens, the yield comes up, let's say 375. As soon as that bond comes up, the bond that was in existence before that is still there, but suddenly that's called the old bond. There is actually a yield difference between those two. One of them is a 30-year bond, the other is a 29.5-year bonds. In the grand scheme of things, anybody who could make differential forecasts of nature of the U.S. Bond market in the last 6 months, I mean, they either have gone to mountain and got some words from Gabriel or Jebrail, as the Muslims call him, or they're completely nuts. But there is that premium. The 29.5-year bond has a higher return. It's not just 1 basis points. Sometimes it's as high as 10 basis points than the new bond. Why the new bond is a lot more liquid? A lot of pension funds, when they buy an existing bond, they kind of buy it to keep it until maturity. That means there is no liquidity in that anymore. Maybe half of the issue is no longer effectively traded. There's even, let me give you an example. Come on. Sometimes this thing freezes. Okay, let's do markets. What the hell happened to my mouse? Let's look at the yields. 10-year bond is trading at 379 or so. 20-year bond, for a lot of different reasons, is higher than that, and we're going to talk about that, about 420. The reasons that makes 20-year bond to have a premium over 10 is exactly the same between 20 and 30. So normally you would expect the 30-year bond to have a higher yield, but it has about 6 basis points lower yield. That's because almost all of those 20-year bonds used to be 30-year bonds. U.S. never issues a 20-year bond. They issue 10 or 30. That means they're really old bonds, and the liquidity is much less. There was, back in mid to late 90s, there was a legendary hedge fund that operated in the fixed income markets, which means, bonds and stuff. It's just called long-term capital management. Any of you guys ever read the book Liar's Poker? It was a book that came out in late 80s, early 90s. It tells the story about when the corporate bond market started in Salomon Brothers, and there was a legendary manager of that bond department, John Meriwether. These people started the junk bond market. Okay, this LTCM was managed by John Meriwether. He was basically God or Buddha or whatever you want to call him of the bond market. People actually, competed, so you mess money with them. One of their biggest strategies was to buy the new bond, the 30-year bond, and short to 29 and a half or 29. You get a yield I'm sorry, short buy the 29 and a half or 29, short the new bonds because the older ones have a higher yield, and they kind of leverage this over about 100 times. Even if you have only 10 basis points difference, if you leverage that 100 times, that makes 10%. And 10% over and above a regular yield is a lot of money. Most hedge funds are compensated based on a relatively nominal management fee, but they have something called success fee. Let's say if the benchmark they put in is expected to make 5%, but they make 10, they're going to take 20% of that extra 5. So that's 1% of the money managed. If you're managing $100 billion, now that's $1 billion income, and which is